The personal allowance is the amount that you can earn free of income tax. It's currently £12,570 a year, but if you earn over £100,000, the personal allowance starts to be restricted. Where income from all sources exceeds £125,140, there is a full clawback of the personal allowance. So all your relevant income is liable to be taxed. Remember here that interest and dividends are counted as income, even though some of this income will be taxed at 0% because of the savings or dividend allowance. The effect of the personal allowance abatement is that income in the £100,000 to £125,140, that band suffers tax at an effective rate of 60%. With this in mind, here are 5 strategies to bring income down to £100,000 and avoid the personal allowance clawback. If you've not yet considered these strategies, you might want to take action before the end of the tax year on the 5th of April to reduce your income tax bill. Strategy number 1, shift income to a spouse or civil partner. You can do this by transferring interests in assets such as shares and properties, or by putting assets such as bank accounts or rental properties into joint names. For married couples or civil partners, this can be achieved without worrying about capital gains tax or inheritance tax. For unmarried couples, capital gains tax needs to be considered as any transfers of chargeable assets will take place at market value. Having said that, gift relief can eliminate any charge for transfers of assets such as shares in family trading companies or furnished holiday lets. Be careful here to make sure that the asset itself is transferred and not just the right to income from the asset, as the shifting of income alone could open the door to the arrangement being attacked under the settlements rules. Strategy number 2, defer any income until after the 5th of April where possible. This may, of course, just be deferring the problem as it increases income for the next tax year, but we can worry about that this time next year, or better still, plan ahead and use another of the strategies. Strategy number 3, exchange a bonus you may be due for additional employer pension contributions. Salary sacrifice arrangements still work for pension contributions, and this can be a good route to consider. Employer pension contributions are tax-free benefits, thereby giving a tax and national insurance saving for the employee and a national insurance saving and a corporate deduction for the employer. You need to watch out for the annual allowance charge though, if your pension contributions are already fairly significant. There's a link in the description below to a video about that that I did earlier this year. Strategy number 4, make personal pension contributions net income for the purposes of the personal allowance abatement rules means income after having deducted gross pension contributions. Paying enough pension contributions to bring net income down to £100,000 means that the pension contribution in this band will be effectively relieved at 60%. That's 20% tax relief at source, an extra 20% by extending the basic rate band, and the final 20% by virtue of the reinstated personal allowance. Personal pension contributions can no longer be carried back to the previous tax year, so the payment must be made by the 5th of April to take effect for that tax year. Please remember to give your pension provider the heads up that this is happening so that ducks are nicely in a row before the 5th of April. Pension provider may ask for information, for example, to comply with anti-money laundering policies, which could take a day or so to be processed, so leaving this to the last minute is rarely a good idea. Care should be taken not to exceed the annual allowance, as otherwise an annual allowance charge could be triggered. For most people, the annual allowance is currently £40,000, but it is increased by any unused allowance of the previous 3 tax years. This affords taxpayers the opportunity to make substantial pension contributions without a corresponding clawback charge. The 5th and final strategy is make charitable donations under gift aid. This also has the effect of reducing income when determining the personal allowance abatement. Gift aid donations should be made by the spouse with income chargeable at the higher marginal rates. Unlike pension contributions, gift aid payments can be paid after the 5th of April and then carried back to the previous tax year as long as they are paid by the earlier of 31st of January after the end of the tax year or by the date when the self-assessment tax return is filed. Thanks for watching. I hope you've enjoyed this video. If you have, please press the like button now. It really does help me. And I have other videos on the state pension and numerous other topics. So subscribe to get quick access to those, or check out the description below for links. My name's Justin King. I'm a chartered and certified financial planner. My aim is to help you live a successful life. That often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Check out the description again below. You can also sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.